Welcome back to Market on Close. I'm Tom White. It's time to discuss Alphabet earnings, a beat, and then we'll look ahead to some tech results for next week. And for that, we welcome in Robert Schein, Chief Investment Officer at Blanke Schein Wealth Management. Welcome to the show.
Great to be with you.
All right. So give me your takeaway here. I think it was almost a sigh of relief for investors as far as Google Alphabet's earnings, just due to the fact that the expectations were so low.
Expectations were low. Google's, did report their operating net income more than doubled. That was a positive. They beat both in the top and the bottom line. Again, another positive. And this should serve as a guide for what we're going to see next week with the remainder of the Mag 7. But, they beat on the top line. They announced share buybacks. And at the end of the day, they increased their dividends, which always is welcome. One of the key components was the cloud computing. That was a highlight. That grew by 28% this year, but they didn't provide too much guidance as it relates to the advertising spend. And that's the unknown of unknowns because of the current backdrop that we're in the macro backdrop.
Yeah, when you take a look at that, Robert, I think that was the sigh of relief that digital ad spend actually came in just a little bit above expectations. Internet search advertising came in at $50.7 billion. That was up 10%, just above estimates here. So does that give maybe a reprieve to maybe some of these other companies that are going to report next week that rely, Meta Platforms gets 96% of their revenue from digital ad spend. Amazon, they continue to grow their advertising arm. So these are, almost, setting the tone maybe for some of these tech names that have been beaten up.
That's so true. And we can't ignore, obviously, we are all subjected to, especially these companies, the sensitivity to the macro backdrop, as we've talked about. But what we're looking for, a consistent theme from basically all of that's going to be reporting next week, is the guidance. We know that's going to be negative and uncertain, but really is the capital expenditure component to each one of these companies. By that, I mean, let's take AI as an example. Are Microsoft and Amazon going to still commit their $170 billion combined to AI, or are they going to pull back? That's a question that we all, as investors, want to know on the earnings, as well as cloud performance. Does that continue to grow? AWS could be a huge continuing driver for, let's say, Amazon. And so all of these little factors are going to tell us sort of the health of the existing tech market. But let's not kid ourselves. Regardless of the macro backdrop, there's still a war within mega tech and these hyperscalers to win the race respectively. So I don't see them, even if they wanted to pull back based upon economic uncertainty, your competitor can take 5 or 6 leaps ahead of you. So I don't think there's going to be too much pullback on the spend in investments.
Yeah, I think Microsoft already came out and clarified, $80 billion they're expected to spend this year on the AI infrastructure build out here. But when you look at the fortress balance sheet and the valuations from some of these big tech names that, they're in bear market territory off their highs from just a month or two ago, they got fortress balance sheet. They've got a lot of cash in their balance sheet. Their free cash flow is pretty rock solid at this point. Does this lowered valuation provide some opportunities here for investors?
Without a doubt. I mean, I don't think we're out of the woods as it relates to, markets made some constructive movement to the upside this week. It's refreshing after the 6, 7, 8 weeks of negative to maybe potentially close on an upside. But let's not forget, we did gap up on the S&P a couple of times this week. And historically speaking, we always have to retrace and close that gap. Whether it happens sooner than later, no one really knows. But the earnings could provide that backstop, if you will, as we continue to next week. And then from a valuation standpoint, we have seen the PE come down, even on the S&P 500 to 19, and we were at 23 just 8 weeks ago. So there's been a lot of sort of opportunity given to all of us in this market. And then specifically, if you look at the Mag 7, one of those areas that we like is Amazon. Amazon's valuation relative to where it is historically, the valuation's cheaper where it is today than it was all the way back in 2009. And oh, by the way, this last quarter, Amazon's contribution to the S&P 500 year-over-year earnings growth was in the top 5. So they're still growing. They're still, relative to, from a valuation standpoint, looking very attractive.
Yeah, getting a little bit cheaper, still down 21.75% from those all-time highs that we saw at the beginning of February. So, and that maybe that's the key, Robert. When you look at a name like Amazon, maybe one of their segments or silos of revenue generation might not be growing that well. Maybe they're in line, but then you've got the Slack pickup in advertising, right? That's become a huge major driver. 18% growth last quarter from the advertising side of it. We don't seem to see any pullback in that spend. So is that one of the reasons that you like it? Or is it just the fact that, hey, cloud computing still growing? They've got the retail side of their business, which has been doing spectacular also. It's just a culmination of all the parts.
It's a culmination of all the parts, but keep in mind, obviously there's the ad, there's the cloud, there's retail, and there's also cost cutting that Amazon's been doing for the last 3-4 years. So the turnaround story is real. And oh, by the way, there's the AI upside. The AI exposure of what Amazon is actually doing will provide the opportunity for the acceleration of the top line growth. We've seen them do this before. I believe the stock is positioned, the cash flow is impeccable. So we're going to see, Amazon could be relative to valuation, relative to Mag 7, one of the most attractive. But for all those reasons, it's one of the things where we like a market like this because it allows us to take advantage of a company like that when it's down.
Yeah, I think some people buying over the last week here in Amazon. Another stock you like, I saw from your notes, Netflix hitting another fresh all-time high today. Nobody's getting rid of their Netflix subscription, Robert. We all know that. And, they continue to execute really well at this point. Do you still like it at these levels? Because on a valuation basis, it's getting, full force there at this point, right?
Yeah, Netflix has continued to outperform. They're dominant in their own, I don't think there's a competitor to Netflix. They're just, competition amongst themselves. Valuation, investors probably could be patient on this one, let it come in a little bit and then take advantage of just maybe a dollar cost averaging strategy over time. So if we have an economic headline that's negative and Netflix gets hit, maybe take a look at stepping in if you don't already have a position. But their subscriber growth is impeccable. The pricing plan that they rolled out and also their advertising model, once again, 55% of the new subscribers are opting into the advertising model, and that's a new revenue generator. And oh, by the way, they're also recession play. So what's interesting to note about Netflix is the last recession that they had, or that we had, their viewership went up, not down. People have more time on their hands. They want to basically get rid of the headlines of the day, and they want to just tune out and tune into Netflix. So for all of those reasons, I think it's a well-positioned. Valuation's a little bit rich, but of a long-term investor, choosing your spots, it's something you might want to consider adding to your portfolio.
Yeah, and I think you take a look at the live sports has become a big boon for them because they're still getting the subscription revenue and they get to throw ads in there. They need more of that, definitely moving forward. And last one I wanted to kind of touch on was Berkshire Hathaway. Warren Buffett, he's built up a big cash hoard at this point. I don't know if he's allocating it. He said everything was pretty wealthy. He said that just a few months ago when we were hitting all-time highs. He was right once again, but you like this stock?
Yeah, the traditional value investor of all time, Warren Buffett, obviously he's got cash. He timed the market brilliantly once again. That shouldn't be a surprise to anybody. But let's keep in mind, back in the Great Recession, he sat on cash until the very, very last minute. And instead of going to the open market, he had companies call him direct. And he started making deals of a lifetime. And that serves the shareholders very, very well. Sometimes he misses markets when they pull back because he really doesn't like a 10% discount. He wants a 20 or 30% discount. But that's what you get. You have somebody who is going to be patient, is going to deploy capital in a very thoughtful manner. But this is a market built for him, and he's got a war chest of cash to take advantage.
Yep, he's playing chess. I'm playing checkers, Robert.
Yeah.
That seems to be the theme all the time. All right, great discussion. Have a great weekend, Robert.
You as well. Thanks for having me.
All right, that's Robert Schein, Chief Investment Officer at Blanke Schein Wealth Management.